Hey everybody, Dr. Phil here. This is going to be a video on long-term planning and financial planning and growth. So let's start by talking about the elements of financial planning. So financial planning establishes guidelines for change and growth in a firm. So obviously most firms want to, grow over time. It's concerned with the major elements of a firm's financial and investment policies without examining the individual components of those policies in detail. Now, to develop an explicit financial plan, managers must establish certain basic elements of the firm's financial policy. These are as follows. The firm's needed investment in new assets, the degree of financial leverage the firm chooses to employ, the amount of cash the firm thinks is necessary and appropriate to pay shareholders, and the amount of liquidity and working capital the firm needs on an ongoing basis. So, what is financial planning? So, financial planning formulates the way in which financial goals are to be achieved. Growth by itself is not an appropriate goal. The appropriate goal for a firm is increasing the market value of the owner's equity. If a firm is successful, growth will usually result. Now, the dimensions of financial planning, well, the first is establishing the planning horizon. The long range time period on which the financial planning process is focused, usually the next 2 to 5 years, is pretty typical. Determine the level of aggregation, a process by which small investment proposals of each of a firm's operational units are added up and treated as sort of like one big project, and derive inputs in the form of alternative sets of assumptions about important variables. So, for example, worst, normal, and best case states of nature scenarios, if you will. So, what can planning accomplish? So, examining interactions. The financial plan must make explicit the linkages between investment proposals for the different operating activities of the firm and its available financing choices. Exploring options. The financial plan allows firms to develop, analyze, and compare many different scenarios in a consistent way. Avoiding surprises. Financial planning should identify what may happen to the firm if different events take place, ensuring feasibility and internal consistency. Financial planning is a way of verifying that the goals and plans made for specific areas of a firm's operations are feasible and internally consistent. And the conclusion, the most important result of the planning process is that it forces managers to think about goals and establish priorities. Now, almost all financial models will have the following elements. So let's talk through these real quick. Sales forecast. Nearly all financial plans require an externally supplied sales forecast. Often, the sales forecast will be given as the growth rate in sales. Pro forma statements. Financial plan will have a forecast balance sheet, income statement, and statement of cash flows. These are called pro forma statements or just simply pro formas. Asset requirements. The plan will describe projected capital spending, and at a minimum, the projected balance sheet will contain changes in total fixed assets and net working capital. Financial requirements. The plan will include a section about necessary financing arrangements, for example, dividend and debt policy. The plug. The plug is the designated source or sources of external financing needed to deal with any shortfall or surplus in financing, and thereby bringing the balance sheet into balance. And economic assumptions. The plan will explicitly state the economic environment in which the firm expects to reside over the plan's life. So here we see an example of a simple financial planning model. So Computerfields Corporation's financial statements from the most recent year are shown below. So we can see the income statement, we have sales, we have the cost, we have net income, we have the balance sheet, we have assets of 500, and then we have debt and equity equaling, of course, 500. Let's suppose sales increase by 20%, rising from 1,000 to 1,200. That's your 20% increase. Planners would then forecast a 20% increase in costs from 800 to 960 and assume that all variables will grow by 20% as shown below. The next step is to reconcile the two pro formas. How, for example, can net income be equal to 240 and equity increase by only 50? Computerfield must have paid out the difference of 240 minus 50, which is 190, possibly as a cash dividend, in which case dividends are the quote-unquote the plug variable. Suppose Computerfield does not pay out the 190, and the addition to retained earnings is the full 240. Then equity will grow to 250, the starting amount, plus 240 net income, or 490, and debt must be retired to keep total assets equal to 600. With 600 in total assets and 490 in equity, debt will have to be 600 minus the 490, which is 110. And because we started with 250 in debt, Computerfield will have to retire 250 minus the 110, which is 140 in debt, as shown in the below pro forma balance sheet. Or we can use a percentage of sales approach. In the simple financial planning model, every item increases at the same rate as sales. This may be a reasonable assumption for some elements, but not for others. For example, long-term borrowing. The extended version of the simple model is examined next. The basic idea is to separate the income statement and balance sheet accounts into two groups, those that vary directly with sales and those that do not. Based on the percentage of sales approach, a financial planning method in which accounts are varied depending on a firm's predicted sales levels. So let's take a look at the income statement in this sort of new scenario. So Rosengarten has projected a 25% increase in sales for the coming year, so we're anticipating sales of 1250. To generate a pro forma income statement, we assume total cost will continue to run at 833 minus the 1000, or 83.3% of sales. So below this, we can see the income statement. We can see our sales of 1000, costs of there's your 833, and then taxable income of 167. Tax rate's 21%, so we have taxes of 35, and then net income of 132. Dividends were 44, so the addition to retained earnings was 88. And then we have the pro forma income statement. This is projected. Now you see the 1250. The cost is 83.3% of the 1250, so 1041. Subtract that from 1250 is the 209. 21% of that is the 44. And so net income in this scenario would be 165. So the effect of assuming that costs are a constant percentage of sales is to assume that the profit margin is constant. The profit margin was 132 over 1000, or 0.132, or you could just say 13.2%. In the pro forma, the profit margin is now 165 over 1250, also 13.2%. Next, we need to project the dividend payments. Let's assume Rosengarten has a policy of paying out a constant fraction of net income in the form of a cash dividend. The dividend payout ratio is the amount of cash paid out to shareholders divided by net income, and Rosengarten's dividend payout ratio for the most recent year was as follows. So 44 was a dividend payout over the net income of 132. So we have a dividend payout ratio of 1/3, 1/3. The retention ratio, or plowback ratio, is the addition to retained earnings divided by net income. That is 1 minus the dividend payout ratio. Let's assuming dividend payout ratio is constant, the projected dividends and addition to retained earnings are shown below. So projected dividends paid to shareholders is 165 times 1/3, that's 55. The projected addition to retained earnings is then 165 times the 2/3. So basically the difference, the 110, is going, the company is keeping the 110, right? Paying out the 55 to shareholders and keeping the 110. So here we see a balance sheet for Rosengarten. So we have current assets, we have fixed assets, total assets is 3,000. And then if we look at the liabilities known as equity, we can see our current liabilities, accounts payable, notes payable, and then we have our long-term debt of 800. And then if we look at the sort of the bottom right, owner's equity, common stock and paid in surplus of 800, retained earnings of 1,000. So of course, total assets and liabilities known as equity equal 3,000, as they should. Now, for items that vary with sales, we express each as a percentage of sales for the year just completed, whereas for items that do not vary directly with sales, we just write NA. The ratio of total assets to sales is called the capital intensity ratio. Now, to construct a partial pro forma balance sheet, we can use percentages just calculated wherever possible to calculate the projected amounts, and for items that do not vary directly with sales, we assume no change and write in the original amounts. And this is what we're doing here. So now, just if you want to, this would be a good place to kind of pause the video, take a look at the projected and the change from the previous year. So, for example, like cash 200, the change from the previous year was 40, so on and so forth. So Rosengarten has three possible sources for the 565 in new financing. We could use short-term borrowing, long-term borrowing, and new equity. Let's assume that Rosengarten decides to borrow funds using a combination of short and long-term debt. Now, one thing I want to clarify here just really quickly is they're talking about this 565 in new financing. If I go back real quick, presumably you paused it here. This is the previous slide. External financing needed, EFN, is the 565. So it's like saying we're 565 short, we've got to figure out where to get that money from. Okay. So what you're seeing here is you can kind of see we've got the long-term debt, we've got the notes payable, right? If we compare that to accounts payable before was 375, notes payable was 100, long-term debt was 800. And now you kind of notice how some of that has changed. Let's suppose Rosengarten is operating at a 90% capacity. What would sales be at full capacity? And what is the capital intensity ratio at full capacity? What is EFN in this case? Well, the full sales capacity would be just 1,000 divided by zero point 0.9, so 1,111. We know that fixed assets are 1,800. We can look at the balance sheet for that on the previous slide. At full capacity, the ratio of fixed assets to sales would just be the 1,800 in fixed assets divided by the 1,111 full capacity sales, which gives us 1.62. So what we're saying there is that Rosengarten needs $1.62 in fixed assets for every dollar in sales once it reaches full capacity. At the projected sales level of 1250, then it needs 1250 times the 1.62. So we're just using that multiplier again, equals 2025 in fixed assets. Compared to the 2250 we originally projected, this is 225 less. So EFN, or remember, external financing needed, is the 565 minus the 225, which equals 340. Current assets would still be 1,500, so total assets would be 1,500 plus the 2025, which now gives us 3,525. The capital intensity ratio would thus be that number, 3525, divided by the 1250, which gives us 2.82, which is less than our original value of 3 because now we have, of course, excess capacity. So what about growth and external financing? So let's kind of talk about how those go together. So external financing needed and growth, of course, are related. All other things staying the same, ceteris paribus, the higher the rate of growth in sales or assets, the greater will be the need for external financing. So Hoffman is forecasting next year's sales level at 600, a $100 increase. The percent increase in sales is 100 over 500 or 20%. So we can prepare a pro forma income statement and balance sheet. So at a 20% growth rate, Hoffman needs $100 in new assets. The projected addition to retained earnings is 52.8. So the EFN, external financing needed, is 100 minus the 52.8 or 47.2. Now, the debt to equity ratio for Hoffman is equal to 250 over the 250, which of course is equal to 1. Let's assume that Hoffman does not wish to sell new equity, in which case the 47.2 in EFN would have to come from debt or be borrowed. Total owner's equity is projected at 302.8, and the new total debt will be the original 250 plus the 27.3 in new borrowing, or 297.2 in total. The debt to equity ratio thus falls from 1 to 297.2 over the 302.8 to 0.98. So debt to equity has actually decreased just slightly. So here we see Hoffman Company income statement and balance sheet, right? So we can see our sales, 500. We can work our way down to net income of 66. And below that, we see the balance sheet with our assets on the left-hand side, also expressed as percentages. And then we see the balance sheets, liabilities, and owner's equity on the right-hand side. And of course, as always, noting that total assets and total liabilities and owner's equity are equal. So here we see the pro forma income statement and balance sheet. So we have projected sales, 600. Again, the 83.3% cost of sales, 499.8. Thus, taxable income, 100.2. 21% tax, so of course 21, roughly. Net income is 79.2. Now, for relatively low growth rates, Hoffman will run a surplus and its debt-to-equity ratio will decline. Once the growth rate increases to about 10%, surplus becomes a deficit. As the growth rate exceeds approximately 20%, the debt-to-equity ratio surpasses its original value of 1.0. And so kind of here we see some projected sales growth, some what-if scenarios, 5, 10, 15, 20, and 25. And for each, you can see the increase in assets required. You can see the addition to retained earnings, the external financing needed, if appropriate, and the projected debt to equity ratio. All right, let's talk now about the internal growth rate. So the internal growth rate is the maximum growth rate a firm can achieve without external financing of any kind. And this is simply calculated as ROA times B over 1 minus ROA times B. So for Hoffman, net income was 66 and total assets were 500. So ROA is 66 over 500 or 13.2%. Of the 66 net income, 44 was retained, so the plowback ratio B would be the 44 over 66, or 2/3. So the internal growth rate, again, ROA times B divided by 1 minus the ROA times B. So now we can just plug in our numbers, 0.132 times 2/3 over 1 minus 0.132 times 2/3. So we get 0.0964 or 9.64%. So Hoffman Company can expand at a maximum rate of about could say just under 10% per year, 9.64% without external financing. Now, the sustainable growth rate is the maximum growth rate a firm can achieve without external equity financing while maintaining a constant debt to equity ratio. The sustainable growth rate is ROE times B over 1 minus ROE times B. Now again, for Hoffman, net income was 66, total equity was 250. So ROE is this, 66 over 250, or 0.264, or we could just say 26.4 expressed as a percentile. The Plowback ratio B is still 2/3, so we can calculate the sustainable growth rate as follows. So we just plug in our numbers, so 0.264 times 2/3 over 1 minus 0.64 times 2/3, so we get 21.34%. So what we're saying there is Hoffman Company can expand at a maximum rate of 21.34% per year without external equity financing. And determinants of growth. A firm's ability to sustain growth depends on the following factors. Number one, profit margin. An increase in profit margin will increase the firm's ability to generate funds internally and thereby increase its sustainable growth. Number two, dividend policy. A decrease in the percentage of net income paid out as dividends will increase the retention ratio. This increases internally generated equity and thus increases sustainable growth. Number three, financial policy. An increase in the debt to equity ratio increases the firm's financial leverage. Because this makes additional debt financing available, it increases the sustainable growth rate. Number four, total asset turnover. An increase in the firm's total asset turnover increases the sales generated for each dollar in assets. This decreases the firm's need for new assets as sales grow and thereby increases the sustainable growth rate. And number five, if a firm does not wish to sell new equity and its profit margin, dividend policy, financial policy, and total asset turnover, or capital intensity are all fixed, then there is only one possible growth rate. All right, that comes to the end of the video. Thank you as always for watching, and I will see you soon in another video.